On this point, I wish to be clear. America first does not mean America alone. To the contrary, it is a call for deeper collaboration and mutual respect among trade partners.
Hello everyone and welcome to the Week Ahead on Nomura Podcast. It's Friday the 25th of April and I'm Dominic Bunning, Head of G10 FX Strategy here in London.
By embracing a stronger leadership role, America First seeks to restore fairness to the international economic system.
That was Scott Bessent, US Treasury Secretary, speaking at the IMF events in Washington earlier this week and offering a slightly calmer tone, which has certainly emanated through markets in the last week. For most of the last month, we've been generally focused on tariff escalation and policies which have created concerns for investors. But the last few days have signalled something of a short-term shift, with some signs of movement towards various trade deals and a potential de-escalation of trade tensions between the US and China. Of course, all of this can change with a presidential post on social media, but for now, investors seem to be taking the progress at face value, with US equities having recovered close to all of the decline seen in the aftermath of the initial 2nd of April tariff announcement. US yields have stabilised and have actually fallen in Europe, something we'll come to later in the podcast, while in currencies there's been a bit less demand for safe haven FX as calmer market conditions return. Now, all of this may allow us to focus a little bit less on the headlines and a bit more on some of the underlying economic data. And to cover this week, I am joined by Andrzej Szczepaniak in Europe to talk about the ECB outlook, Yuichiro Nozaki in Japan to discuss the BOJ and US-Japan trade talks, and finally, Rishi Sharma in the US to focus on the labour market data there and also the Canadian election. So, with no further ado, let's get stuck in. We're going to start this week in Europe. I'm joined by Andrzej Szczepaniak, who's going to talk us through a big change we've made to our ECB forecast. Andrzej, what's happening on the ECB?
Hey, Dominic. So in terms of our ECB view, we're now forecasting an additional 2 25 basis point rate cuts in July and September. So that brings our terminal rate for the depot rate down to 1.5% from 2% previously. And really in part, obviously, if you sort of think about it, the ECB meeting in some respects for April was more dovish than we'd expected. Also, the most recent data over this past week has also showed more deterioration, in particular, actually, in terms of the details on the services sector rather than the manufacturing sector. As you recall, some people had thought the manufacturing side of the equation should be a bit weaker owing to the Trump tariff announcement on the 2nd of April. That wasn't actually the case. It came in marginally weaker, but it was really down to the services sector, which potentially reflects more underlying fundamentals. And likewise, consumer confidence was also weaker in that respect. And then finally, just to sort of add on to that, ECB speak since the April meeting has continued with that dovish theme, even from hawkish members such as Nagel, Knot, etc., all underscoring that actually they have to now almost respond to this tariff shock. And so that's why we're now thinking, obviously, from that perspective, they will actually cut rates to below neutral. So give or take, neutral is the sort of 2% and bringing it down to 1.5% by September.
That's really interesting. I mean, the market pricing is pretty close to that, I guess. So we are kind of moving a little bit more towards the market versus being a bit more hawkish before, but still quite a big change. And I think what's kind of interesting there is that inflation is not really back at target just yet in Europe, but I guess the ECB is showing a bit more concern about the growth data. We actually get a bit of a snapshot on both growth and inflation next week. So in terms of the inflation data, what do you think we're going to see?
So from that perspective, this inflation is very much on track. So headline HICP, we're looking at a small decline to 2.1% from 2.2 previously. In terms of core HICP inflation, we're thinking of the stubbornness there in terms of the annual rates, so unchanged from the March print. But in terms of the underlying momentum, so the monthly season adjusted print we think should come in marginally softer. But I think, as you say, obviously, from the ECB's perspective, if you look at, say, their recent rhetoric or prior to the tariff announcement, they focused heavily on services inflation. And obviously, the underlying momentum in services inflation is still a bit sticky. But on the other hand, they're very much now focused on the potential hit to growth down the line from these tariffs.
And on that growth front, what do we expect the Q1 number to be when it's released next week?
So obviously it's worth bearing in mind Q1 shouldn't really have any material impact or meaningful impact from tariffs, given they haven't really, well, the tariff announcements and what came into force was to the back end of Q1 and obviously from April. However, we are thinking a slight moderation from 0.2 in Q4 last year to 0.1 in Q1 this year. Obviously the risks there are finely balanced, especially if you see some front running of in expectation of the tariffs being introduced.
Great. That's really helpful, Andre. Thanks very much and have a good week.
Thanks, Dominic.
Moving on from Europe and the ECB view change, we also have a Bank of Japan policy decision coming up. Yuichiro Nozaki from our Japan economics team is with us. Nozaki-san, what do we expect from the BOJ this week? Is an unchanged policy a pretty consensus outcome?
Yes, we expect the BOJ to read its policy late and change it at the next meeting. On the other hand, we expect the BOJ to maintain its basic stance of continuing rate hikes to adjust monetary policy easing. In the Bloomberg survey conducted for Japanese economists, no one of 54 respondents expect rate hike in the next meeting. So the skip of rate hike is consensus. There are two major points to watch in the meeting. One is how the BOJ's outlook for GDP growth and CPI inflation will be revised, reflecting the trade policy by US President Donald Trump. We expect GDP growth for 2025 will revise down to 0.6% from the previous outlook of 1.1%. The other is how Governor Ueda takes the balance between the basic stance of continuing rate hike and downside risk to the economy.
Okay, thanks very much. And in terms of the broader view, and we've actually changed our terminal rate view in Japan recently as well. Can you explain the thinking behind what's happening there?
Last week, we changed our BOJ call. We previously thought that next rate hike will be in July this year. But for now, we expect the hike in January next year. And the BOJ will keep its policy rate at 0.95%. Until the end of our forecast period of March 2027. We expect that the Japanese economy will decelerate to Q3 this year, and it has become difficult for BOJ to resume the rate hike process until they can confirm the bottoming out of the Japanese economy by the actual data. In addition, the government is considering the economic packages from this summer to autumn. So in terms of policy mix, it is difficult to raise interest rate this year. In January next year, we think BOJ can raise interest rate after confirming the continuing wage hikes for next fiscal year and economic recovery. However, the wage hikes for 2026 will face downward pressures from deteriorating corporate earnings. We believe the wage hikes and inflation will not be strong enough for further rate hike.
Great. So a slightly softer view there. I guess the other big policy that people are thinking about is trade policy. We've had some meetings between the US and Japan in terms of trade and maybe even FX policy. What are the latest signs coming from those meetings?
The negotiations are split to two parts. Trade negotiations between Akazawa, Minister of Economic and Fiscal Policy, and Greer of USTR, and FX meetings between Kato, Minister of Finance, and Treasury Secretary Bessent. In terms of trade policy, Akazawa visited the US last week and had the first negotiations. It is not clear exactly what kind of negotiations took place, but given the positive messages from both sides after the meeting, at least the worst-case scenario of an immediate collapse of the negotiations is avoided. The next round of negotiations is expected to take place in the end of this month. So next point is then. There are three main points that the US is expected to demand to Japan. The first is increased import of agricultural products from the US. And the second is to ease automobile safety standards to import more US cars. And the third is to increase Japanese burden of defense costs. Given that the upper house election is scheduled in July this year, and the LDP, ruling party in Japan, has a large political base in rural areas and farmers, it is unlikely to make major concessions in the agricultural sector. Kato and Besen met yesterday. After the meeting, Kato said that no exchange rate targets or exchange rates management frameworks were discussed. So at the moment, the risk of the yen becoming too strong against the dollar appears to be receding, as the US side has shown an emphasis on trade issues rather than exchange rates.
Yeah, and that's definitely something we would agree with on the FX side. While we do think the yen structurally will probably strengthen over the next, few months or the next year, I don't think much of that is going to come down to some kind of currency accord. It still seems like that kind of agreement is some way off. Anyway, thank you very much, Inazaki-san, and we'll speak to you soon.
Thank you very much.
Moving on from Japan, there are two other notable data events in Asia this week, both occurring on Wednesday, the 30th of April. The Bank of Thailand decision is due, and we expect a rate cut to 1.75%, which is on the more dovish side of consensus that's currently split 50-50 on whether policymakers will actually ease this time around. We're also looking for some fairly chunky downward revisions to the central bank's growth and inflation forecasts, and a dovish statement to accompany the decision, with a good chance that some voters will opt for a larger 50 basis point cut. Meanwhile, in Australia, Q1 inflation is due and takes on plenty of importance in the context of market rate pricing, which has shifted to quite a dovish expectation, with the market looking for rates to go down towards 3%, much bigger than we expect in terms of the RBA's cut profile. Just in terms of the data, we expect headline CPI to have risen 0.9 on the quarter, so a touch stronger than consensus. And we also look for above consensus prints on the trimmed mean measures as well. Although we do note that year-on-year rates will move back to the RBA's target range, which should allow them to cut in May. It's just the speed of cuts thereafter where we're a bit more sceptical than the market pricing. We're going to finish this week in the US, where I'm joined by Ruchir Sharma from our US economics team. Ruchir, I want to get away from tariffs for a little moment here. We've been talking about that non-stop for the last few weeks. In terms of the US data, we do have had a bit of a soft patch in terms of the survey data that's come through. Is there much risk that that's going to feed into non-farm payrolls this week, which is really the big data release in the week ahead?
Hey, Dom, so it's great to be back. And yeah, apart from the tariff headlines, actually data has held up pretty well. And as for the April NFP, despite heightened uncertainty, job gains remained solid in April. We expect they were around 160K, while the unemployment rate was sideways at around 4.2%. So looking at the data, claims data have been benign, and continuing claims have actually fallen over the survey reference period. Service sector employment measures, they've also moved up. As for government job gains, they likely moderated in April as the federal hiring freeze continued, and the Beige Book also reported that there were few instances of DOGE-related job cuts. But overall, we think that layoffs have remained low, and labor markets appear to be cooling, but only gradually.
Okay, so not too much of an impact in terms of the labour market yet, at least from the surveys. But in terms of the activity data, we also get GDP for Q1 released on Wednesday. Do you think that there'll be much of an impact from tariff uncertainty feeding through into that Q1 growth number?
Yes, certainly we are expecting some sort of a slowdown, and it's been a noisy quarter, especially due to tariffs. And we expect Q1 GDP growth slowed to sub 1%. That's 0.5% quarter on quarter from 2.4% in the previous quarter. Now, that's definitely a slowdown, but it's important to drill down and look at the parts. So imports primarily jumped sharply in quarter one due to some front loading in anticipation of tariffs, and consumption also slowed in Q1 after a strong couple of quarters. And so what's our outlook for 2025 is that we think that tariffs will be a headwind for consumer spending, and policy uncertainty is likely to dampen business investment. leading to significantly below trend growth in 2025. I'll say that recession risks have definitely notched up, but our base case remains for a continued expansion.
Yeah, and I think some of that view has, been reflected in Fed speak recently as well. Yes, there could be some downside risk to growth if they were to materialize. The Fed could start cutting, but until they actually see hard signs of that coming through, it seems pretty unlikely that they'll turn much more dovish, especially with inflation still pretty sticky. But away from the US, over the border, I also want to talk about Canada this week. We've got the Canadian elections coming up, and it's been quite a volatile race. It looks like Mark Carney's Liberal Party have staged quite the comeback over the last few weeks. What do you make of the race itself, and what economic implications do you think it could have depending on the result on Sunday?
I definitely agree with you. It's certainly been a remarkable ride in polling. The Conservatives were cruising along in 2024, and they were leading Liberals by over 20 points at a point in time because voters were frustrated with economic slowdown and rising prices. But the race was upended when Trudeau resigned and Trump actually sharpened his attacks on Canada. And as you said, currently polling suggests that Carney's Liberals are leading, and they're poised to surpass the halfway mark of 172. So they're all set for a majority government, probably the first since 2015 elections. So as for the market implications, I'd like to talk about two aspects. First of all, irrespective of whoever wins, the government is likely to focus on some sort of stimulus to provide succor to Canadians from tariffs and then engage in negotiations to ratchet down trade tensions. Another thing is that policies from both the major parties, they aren't catering to fiscal austerity per se, and this is going to lead to rising deficits and put some upward pressure on neutral rate. But looking at the near-term monetary policy outlook, we think that it's unlikely to alter the policy path for BOC materially, since Macklem has been time and again focusing on the importance of fiscal policy to deal with trade tensions. Now, looking at what would happen in a Liberal versus a conservative win, a Liberal majority or even a minority is unlikely to solicit a negative reaction since it would imply a stable government. And in fact, Trump called Liberals maybe better to cut a deal with. So if they win, probably it will fuel hopes of some de-escalation. And if the Conservatives are able to pull off a win, it's likely going to be a minority government, and this might be seen by markets as something resulting in some sort of an escalation, since Pierre Poilievre has focused and he's vowed dollar for dollar retaliation.
Well, interesting stuff. Certainly seems like it's still all to play for there, and we will be watching that very closely over the weekend. Thanks again, Ruchir, for joining us.
Thanks for having me.
That's it for now, and thank you again for joining us at Nomura Research on the week ahead, edited and produced as always by John Dalton. You can like and subscribe to Nomura's podcasts on Apple, Spotify and SoundCloud, or your usual podcast provider. You can also check out nomuraconnects.com for more of our research and updates. We would love to hear your feedback, so please do feel free to write a review and share this podcast with friends, family and further afield. Thanks again for listening, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.